Rick Schumacher with LBM Journal. Thanks for joining our webinar on how the death tax impacts your estate and tax planning. Today's webinar is presented by Sam Brownell, founder and financial advisor at Stratus Wealth Advisors, who's also the sponsor of today's webinar. Sam has been a financial professional since 2006 and formed Stratus Capital Management in July 2013, which has since grown into Stratus Wealth Advisors to provide goals-based financial planning and investments management to individuals, families, and independent business owners. As the firm grew, an increasing number of independent business owners sought Sam's advice on their short and long-term planning needs, including valuation, tax strategy, business continuity planning, and succession planning. In 2019, Sam obtained the CVA certification from the National Association of Certified Valuators and Analysts in order to better serve the valuation and succession planning needs of his independent business owner clients. You can learn more about Stratus Wealth Advisors at stratuswealthadvisors.com. So a couple of details before we get started. All attendees are muted, so you can hear us, but we can't hear you. If you're having technical issues, click the chat button at the bottom of the screen to send us a message, and we'll work to quickly address any problems. If you have questions for Sam, click the Q&A button at the bottom of the screen. Anytime during the presentation, he'll address as many questions as possible at the end. And we expect this webinar to be finished in about 30 to 40 minutes. We are recording it, and we'll send a link of the recording to everyone who registered. Plus, it will be posted on lbmjournal.com. And with that, I turn it over to Sam.
Great. Thanks, Rick. Thanks to the LBM Journal crew for having me and setting this up. So today we're going to spend about 25 minutes here of prepared remarks talking about this idea of the death tax, right, or the estate tax. What gets taxed when you die, how to avoid or at least mitigate that, especially as an independent dealer who typically has, if not just an operating business, real estate too. And in many cases, real estate that has appreciated quite a bit since the business might have been founded and launched prior to or just after World War II. So we want to talk around those issues. This is becoming a bigger deal if those of you who follow either the National Association here in DC or your regional associations, there has been a push on Capitol Hill in DC in both the Senate and the House to repeal what they're calling the death tax, which is the estate tax. And one of the reasons behind that is because it can be punitive to small business owners and family businesses that grow over time to where the business plus the real estate can be worth quite a bit of money. And at the end of the day, as they're trying to move that business to the next generation, there has to be some planning to be done so that we don't end up giving away that growth to a 40% tax rate above what's called the exemption. We'll get into some examples of this in just a minute here. So as Rick said, my name is Sam Brownell and I work Stratus Wealth Advisors. We do most of our work with the independent LBM space. And what we do is everything from doing business valuations to full-scale succession planning, helping you think through what you need to do. And then if you need to, helping to tie that succession plan in with your personal financial planning. And we can provide asset management services if those are necessary. And if not, we're happy to work with the folks you have. So try to make it very collaborative with ultimately looking at what we call a three-person win, right? We're trying to get a win here for you as a business owner, whoever's coming in to take over the business after you leave, and then of course your loyal employees and customers. So this has been going on for as long as there has been an inheritance, estate, death tax, whatever you want to label it. People feel like, I've spent all this time, I've built a good net worth here. Why does just the mere fact that I'm going to die mean that the government can come in and tax a certain portion of my estate? And for a long time, this was fairly low. You know, back in the 70s, the exemption, I think, at the federal level was between $1 and $2 million. It has since gone up, and we'll talk about it, about where it is now in just a slide or two. But the real thing to keep in mind is, and one of the reasons we're talking about this today is, as of December 31st, 2025, if there is no movement in Congress to extend the current estate tax levels, they will be cut in half, which means that if you are to die in 2026, 2027, that could be a problem, because if you have planned, or if you are thinking, well, the estate tax is not going to impact me, well, it may not now, but if nothing changes, it could in a couple of years. And so it's important to get an idea of where we're going. So our aim today is to go through these 4 questions. We're going to look at, how do I determine if the estate tax is going to impact me? How do I protect my next net worth? Thinking about taxes on the actual sale of the business, because at some point, unfortunately, taxes are going to catch up with us. And then what are some things I should be thinking about right now? So a quick overview. When is the estate tax triggered? So in 2023, there's a level for individuals, right? So if you file as an individual or head of household, there's one level. If you're married filing jointly, the level is doubled. So that's important to know. You get taxed on anything above that level. So if I have an estate of $30 million, I'm going to get taxed 40% on the difference between 30 million minus 25.84 million. If my estate is 20 million, I'm not going to get taxed if I die this year, next year, or in 2025. Okay. The other thing is that Congress has now allowed the estate tax exemption to grow with inflation. So it does bump up a little bit in terms of cost of living from year to year. But the big issue here that we want to talk about is there is going to be a reduction coming up. And so how the estate tax will impact you, it's going to be a different calculation if we're talking today versus 3 years from now. So let's walk through a hypothetical example here. Here's a dealer. Got a couple locations, 30 million, no debt, million in cash, 8% EBITDA margin. They own the property. The property has been appraised at $10 million. And in many cases, we see that folks set up 2, 3, 4 generations ago in an area that was close to, but not immediately in a major metropolitan area. Let's say outside of the Dallas-Fort Worth area. Well, as things have expanded, you have ended up in a much more urban area, and the real estate you're sitting on may be worth quite a bit of money. And that can't be ignored as we're looking through this, as we're doing this analysis. And so one of the things here, and this is just a quick calculation using EBITDA to determine value, is, all right, let's say it's an 8% margin. We've got 2.4 million in EBITDA. Right now, multiples are not as high as they were. We're assuming 4.5 multiple. Let's say the business is worth $10.8 million. Okay. Now we have to turn that into an equity value, right? The EBITDA gives us what's called enterprise value. We want to know what the equity value is, because that's the value that matters to you as the owner, right? That's what I can walk away with. And if I were to die, that's the value that will be reported on your estate tax return. So making that conversion, right? We subtract debt, which there isn't any, and we add $1 million of cash. So we're looking at $11.8 million of equity value in the business. And so now what we need to do is we need to think about how these factors are going to impact our timeline. Right now, it may not matter, but as I said before, that second bullet point, starting January 1, 2026, that estate tax limit is set to be reduced by 50%. So instead of almost 13 million and 26 million, it's going to be reduced to, at 2023 levels, 6.5 and just shy of 13 million. So that will be adjusted for inflation, obviously, but you can see the impact here, that maybe by 2026, we're talking about a little over 7 million for individuals and a little over 14 million for somebody who's married filing jointly. That's a big difference than almost 13 million and almost 26 million. And so the question that we have to ask ourselves here is, how much of my business do I want to own post 2025, especially if we are looking at it from an intra-family transition, but also just in general, you know, that the estate tax is what it is, and the estate exemption is what it is. And so if you were to die, it's going to impact you regardless of who you're planning to sell the business to. But there are some ways and some strategies we can use to start thinking about how to move or structure your estate, right? The net worth you have to protect it. And we'll get there in just a second. So finally, we need to determine a net worth. And we're going to look at this in two different scenarios. 2023, you're married filing jointly. You add up all the assets you have here. You have a total estate value of 23.35 million. Congratulations. That's less than what the estate tax exemption is. No estate tax will be due. So if something were to tragically happen, God forbid, and you were to die in the next 3 years, so 2.5 years, there would be no estate tax due in this hypothetical situation. Now, let's take a look at what would happen if those exemptions were cut in half. Now, we do have a taxable estate. We have a taxable estate of almost $10 million. And so from the federal government level, we'd be paying a little bit more than $3.75 million in taxes would be due to the federal government. And that doesn't even count for the fact that depending on what state you're in, some states have their own state estate tax that would add additional burden on the family after that. And so part of it is we want to try to keep as much net worth with your family as possible. The other part is if you're a business owner, you may not be sitting there with almost $4 million to pay out estate taxes. And so liquidity becomes a very important piece of the planning picture here, because you don't want to set up your family with a situation where, oh my goodness, we have to pay a huge sum of money to the government. Where are we going to come up with this money? Boy, we're going to have to go for a fire sale, right? We're going to have to start selling assets at a fire sale. That's not a good situation and one we want to avoid. So let's talk a little bit about protection, right? How are we going to protect our net worth here? And this is where that succession planning process comes in. And this is where we tell folks, if you're going to do this right, 3 to 5 years. It takes 3 to 5 years, partially because there's a lot of work to do, and also because we know you're busy. And so it's going to take time to get everything put together. And it all starts with, who wants the business? Who do I transition this business to? Have I thought about it? Have I talked to my children? Do I have a key manager who's interested? Are there people who I would sell it to? Do I have a strategic competitor out there? Are employee ownership options an interest to me? Right? They may be, and we'll talk about that in a little bit, especially if you're a C corporation. There can be some great tax advantages to going the worker ownership route if you don't already have your own internal successor set up. Then it comes to the implementation. And a plan is only as good as whether or not you can implement it successfully. And so there has to be a timeline here. And what we always do is, let's start where we want to end up, which is that ultimate transition, and work backwards. What do we need to be doing today to make sure we can get to where we want to be 2, 3, 4, 5 years down the line? Right. And so some of the things we can think about are, is gifting or granting an option? Gifting would be my son or daughter, or maybe both, want to be involved in the business. Can I move 10% of the business a year for 3 or 4 years to them? Can I afford to do that? Right, which is another good question. Granting is the same idea, but now this is giving part of the business to a key employee, a non-family member. But what we're really trying to do here is we're trying to shift some of the burden of the tax and the net worth off of the owner or owners to the next generation of leadership. Right? They're typically at a lower tax rate anyways. But we can do this, and we can set the succession plan in motion so that we can start transferring ownership. We can start getting those people motivated, getting them involved in some of the key decisions of the business, while also being mindful of what's going on in the overall estate. Another part of the planning process is taxes on the sale. How are we going to structure the sale to make sure you walk away with the most net? Right? Because let's say, great, in this example, the business is worth $10.8 million. The enterprise itself, for $10 million, I should say, 10.8. What of that are you actually going to walk away with? And that becomes a big question. And we'll talk a little bit later about a stock versus an asset sale, because it's really important. Each gets taxed in a slightly different way depending on the way that your company is set up. And finally, legal documents. Legal documents are crucial, but most people, they've signed them at some point in the past, and you don't really think about them until something happens. You know, a co-owner dies. Somebody in the family gets sick. You yourself have a heart attack. And these things tend to go, oh, geez, I need to go and take a look. When was the last time I updated my will? Do I have somebody out there who could be a power of attorney for me? You know, this idea about trusts becomes important. Is it better from an estate purpose for me to have my business interest owned in a trust as opposed to owned outright individually by me? Because remember, a spouse, there is no exemption on how much can pass from you as the owner of the business to your spouse. So perhaps putting a trust together that specifically states how those assets are to be managed and administered, to say, well, the interest in my business is going to go to my wife upon my death, and these are the parameters that I'm setting up. Maybe that's worth it. It's worth a conversation with your team, your CPA, your estate attorney, your financial advisor. It's worth thinking these things through, because one of the things that we like to do in a succession planning process is set up what we call an asset ownership chart, which shows what are all of the assets that make up your net worth and how are they owned. If they're owned by you individually, what happens if you were to die? Who gets them? Do they go through probate? So we want to make it as easy as possible for whoever is left to get as much of the net worth as possible while reducing the taxable burden. And then the final two things you look at from a legal standpoint are, there's something out there called a professional will, and that it's not as legally binding as the will you make, your last will and testament. But from a business perspective, this can be really useful. If you were to become disabled in a coma after a car crash, not necessarily even dying, who's making payroll? Who's thinking about hiring and firing? Who has access to passwords? You know, all these things become really, really important to protecting that net worth. And then, of course, if you're an owner of a business and you have partners, that buy, sell, or shareholder agreement will lay out what happens if one of the partners hits what we call a trigger event: death, disability, divorce, personal bankruptcy, termination, retirement. You know, any of these contingencies need to be covered so that there's a clear roadmap of what to do. How does my family get paid if I die? You know, a good example is we've worked with a business where one of the business owners got into a car crash and tragically died. And all of a sudden, the family's sitting there going, what do we do? How do we get paid out for that stake of the business? Do we owe taxes? All of this stuff, if it's set up in advance, it makes it a lot easier. It's still very sad from an emotional standpoint, but we don't have to deal with the emotions now also trying to figure out, what the heck do we do? Well, is the business worth this much or this much? How am I getting paid out? Why am I not getting paid more now? All of that stuff becomes critically important. So as part of this, as you're thinking through the estate, part of it is the sale of the business. How do I transition the business? And what am I going to do on the tax side? So as we said before, use of gifting and granting, that can be really, really valuable. Another thing we like to do is run what we call a post-ownership cash flow analysis. Are your assets, business and non-business, enough to support what you want to do post-ownership? If they are, maybe you don't need 100% of the sale price. That makes it a lot easier to do a gifting or granting. And maybe I need 70% of the sale price. Well, over the next 3 years, I can gift or grant 10% a year. And then at the end of that third year, end of 2025, we sign a note. I get paid out for that 70% over 5-7 years, whatever the deal is at that point. But it's really important to know how much you need out of the business, because that again goes back to, what is my net worth? How do we protect that net worth? and how do we make sure that we're not giving money away in taxes that we don't need to. Right, and the final two things we'll talk about that are a little bit more technical, I've got a couple slides on those, are stock versus asset sale, and then an ESOP or co-op sale, right? And these are sales, these are broad-based employee ownership, selling to your workers. And like I said, there can be some very good tax benefits, and we'll talk about those. So gifting or granting. We've been over this. This just gives you an idea of a couple different strategies, but typically you gift or grant over a couple years. You keep the people who you're gifting or granting to in a minority position because you don't want to turn over ownership of the business until you're really convinced that whoever is taking the business is going to be able to do as good a job as you, maybe in a slightly different way, but you don't want to turn over the business as we've seen happen in the past and then go, uh-oh, this person doesn't know what they're doing, and then have to buy back to get yourself back in a majority position. That's not what we want. We want to give a longer runway. And again, that's why we're talking this 3 to 5 year timeline. But the planning does make a huge, huge difference. Stock sale. Now, this is if I have LBM Dealer LLC and I am selling it to Rick, and he doesn't have a business already, he's probably not going to want to create a business just to buy the assets of my business. He's going to want to take over the business that I have. I've got contracts set up. I've got good relationships with vendors. This is what is a stock sale, right? And in this case, doesn't matter what type of corporation you are, if you're a C, if you're an S, or if you're a limited liability, you get taxed at long-term capital gains if you've owned the business for more than a year, which is the case. Right? You wouldn't have a good business that was worth anything if you'd owned it for less than a year. Right. And so this is a good way to transfer ownership. And we typically see a stock sale happen when I'm selling to my kids, I'm selling to a key employee or employees, or I'm selling to a broader base of my employees. You know, workers have been with me for 5 years, they've had no negative reviews. We're going to sell to them in an ESOP, let's say. That can be a very powerful tool. The stock sale is the way to do it. Right now, there are some downsides here, but the idea is who are we selling it to and what are we going to get taxed at? And with a stock sale, it's typically long-term capital gains. Now, an asset sale, and this is more pertinent to the M&A world these days. This is Rick has his own company. He's buying my company. He doesn't want to take on all of the liabilities that I have. He already has his own. He just wants to buy the assets. He wants to buy the operating pieces of my business. So these are typically a mix of taxes. Right? They're taxed at ordinary income and capital gains, depending on what the asset mix is. Right? And for C corporations, this can be tough because there are 2 levels of tax here. Right? The sale will be taxed at the corporate level, and then any distributions made from that C corporation to the owners get taxed again at the owner's income. So there aren't a ton of ways around the asset sale necessarily, unless you go ahead and change your C corporation to another type of entity. But if you do that, there's a 5-year period that you have to wait before you sell anything, because the government's going to say, "Oh, wait a second, you can't just become an S corporation to avoid double taxation. We're going to make you wait 5 years." So again, planning becomes really important here to protecting your net worth. Right. So the coordination between everybody, this is where a CPA is critical, so that we know what we might be paying and we can try to mitigate things to the extent possible. And then finally, this idea of broad-based worker ownership, which is gaining more interest now that there is less family interest, intra-family succession we're seeing. There's this idea that I have a ready-made market for my shares in the people that work for me, and who knows my business better. And so, as we talked about from a tax advantage standpoint, if you have been one of these entities, C corporation, S corporation, or an LLC can choose to be taxed as a C or S. And we see this a lot of times in this industry to, for example, avoid things like a franchise tax. So maybe there's a way to do that. We want to be an LLC for flexibility, but maybe we want to be taxed as a C corporation, depending on which state you're in. So that can be really, really advantageous. But if you've been any one of these types of companies, there is a great opportunity to defer capital gains taxes. And in some cases, I mean, an ESOP, if it works, it's expensive and it doesn't work for everybody. But if I sell shares to an ESOP, if I sell more than 30% in the first year, and I take whatever that price is, so let's say the business is worth $10 million, I sell $3 million in year one. I take $3 million of cash and I invest it in stocks and bonds of US corporations. I can defer capital gains taxes indefinitely. Now, if I take that C corporation that I sold to the ESOP, and the next day that everything is sold, I change that to an S corporation, I don't pay any taxes on my net income because an ESOP is a type of retirement plan. And so in retirement plans, it's tax deferred. So I'm only going to pay taxes when I get bought out of the ESOP. The net profits that are part of the ESOP, that 30% in this example, nobody pays taxes on that. So these can be some really good options to explore. They don't work for everybody, but it's worth it to know what is out there, because at the end of the day, we want to figure out how to move ownership from the current generation to the next generation while protecting that net worth of the owner who has built the business to where we are today. So finally, what do we do? What should we do right now? And it's as simple as the ABCs. Appraise your business, build your succession plan, and calculate your net worth. And these are 3 good steps you can take right now. Business valuation tells us what is the business worth. If you own the real estate, highly, highly suggest that you have a real estate appraisal done. Because my guess is that if this property has been owned for multiple generations, it is worth a lot more now than what you paid for it. And again, we have to consider that. Right? If we're going to sell the real estate, there's capital gains taxes. If it stays as part of our estate, are we bumping up against the estate tax limit? Do we need to start thinking about ways to split the real estate out from the business? And a lot of people still have that real estate held under the same umbrella. Do we need to split that out? Is there a way to transition each of them separately? You know, maybe we sell the business to a third party, but we rent the real estate to that new third party, and that business becomes not only cash flow for the owner, the real estate, the business paying the real estate lease rates becomes cash flow for the retired owner, while at the same time, that real estate can be passed down to the next generation. So we've reduced some of that owner's stake in the real estate, bringing down their estate in total, their net worth. So these are all things that need to be thought about here, but it all starts with that appraisal. We've got to know where we stand today, because that helps us with the succession plan. And we can't really calculate our net worth unless we know what our assets are actually valued at. So we're here to help. Please reach out. We can do anything for you, but you have to come to us and we'll start a conversation. We're happy to give complimentary consultations. We're not lawyers. We don't charge by the hour. So please reach out. We're happy to talk through your situation. Every single dealer that we work with or have worked with is unique. And so you're going to have a few things that are like other folks, and then there'll probably be some things that are different than other folks. So it helps to talk it through. And even if you're not ready to pull the trigger right now, or maybe even in the next 2-3 years, just getting an idea of what you should be thinking about can be really, really helpful. So with that, I will turn it back to Rick and see if we have any questions.
All right. Well, Sam, that was great. Thank you for sharing all that info. We do have a couple of questions, and we have one comment I wanted to read first.
Sure.
I learned a lot from this webinar. Thank you for sharing all of this knowledge and for giving me some important things to think about as I plan for the future of my business. So
Yeah, my pleasure. My pleasure. It's happy to do it.
all right. What makes an estate or gift tax valuation different from a valuation for the sale to a third party?
Good question. So when we're, the easiest way to think about that is, if I'm selling my business to Rick, I want to get as much as possible. So I want to try to make the business look as good as possible, as high cash flow, clean balance sheet. If I am doing an estate or gift tax valuation, my goal is to try to bring down the value of the business. Not ridiculously, right? That's when the IRS starts looking into it, but there are certain things we can do. We can put discounts in. If I am a 25 or 30% owner of the business, let's say, I don't have a majority stake. So we can take a discount there for lack of control. Right? I can't by myself come in and say, we are going to do this like I could if I own 51% of the business. The other piece of it that we can do is what's called a discount for lack of marketability. So unlike Apple or Google, where if I want to buy or sell, I just go on my phone and click sell and it's done. There's a ready huge market of people transacting in stock of publicly traded companies. In a private company, that's not the case. There are a lot of costs that go into this. There's a cost if you hire an investment banker, there are costs for lawyers, for consultants like us, valuators, CPAs. So all of these frictions, plus the fact that it takes longer, right, for you to transition a business, those are discounts that we can take into consideration and reduce the value of the business. And so maybe instead of, as in our example before, $10.8 million, we may be able to gift 10% of that, not at $1.08 million, maybe at $900,000, maybe at $950,000, including some of these discounts. And so that becomes really key when we talk about protecting your net worth and moving it to the next generation. Is we can do it, and we can do it at a level that reduces it a little bit, which allows you to push more through that estate tax exemption. It gives you a little bit more bang for your buck within that, what now is 25 million, but could go down to 13.5 or 14.
Got it. All right. What type of value is determined when completing an estate or gift tax valuation?
Yeah, so I mentioned it briefly before, but it's a good question. So there are two types of values for a company. One is called enterprise value, and that's the value for the operating assets and liabilities of the company. Then there's this idea of equity value. And so if you go and look on your balance sheets, you'll see asset section and below it liabilities, and you subtract those two and it's equity. And that equity piece is what the owners are going to walk away with. And so when we transact a business from an M&A standpoint, it's going to be at enterprise value most likely, because it's going to be an asset sale, right? If Rick has a company already, he's not going to want to buy the stock of my company. Now he owns two entities. He's just going to want to buy the assets. In an estate tax valuation, it's the equity that matters, because we're trying to determine what is the value of your estate. And it's the same thing with a gift tax valuation. And in order to do that, we need to know what value matters to the owner, and that's that equity value. That's what I take away after all the liabilities have been paid, after all the fees have been paid. That's what I walk away with. So it's equity value that is important when you look at estate and gift taxing.
Got it. All right. I'm very active running my business. I'm in good health and don't have plans to retire anytime soon. Since the rules and laws change over time, when should I start putting a succession plan in place?
Yeah, so it's a good question. And I think that the answer, you're already thinking about it the right way, which is timeline wise. And it doesn't do a whole lot of good to get really worried about, let's say, the December 2025 deadline. If you're still, let's say, in your early to mid 50s, right? You probably have 10, 15, maybe even 20 years left to go. A couple things that I would suggest doing is looking from an operational standpoint. So the estate gift tax, that piece of it may not be as pertinent to you right now from a succession planning, but from an operational standpoint, start thinking through, do I have a good bench of leaders? Are they my age or are they younger? Because what we find in a lot of cases with succession planning is, I've got this great leadership group, but they're all my age. And so when I leave the business, at least one or two of them are going to go, yeah, I like Rick, but I don't know if I really want to spend a whole lot of time working for him. I've enjoyed working for you. And so you end up with some key people leaving very quickly after the owner, which can be very detrimental to the business. So start looking at the people you have, because that's really what drives the business. So get the right people in the right seats now, and make sure that you've got a program to bring, not just to bring younger people in, which is a challenge in all industries, but to show them a way, a path for growth. How can I be the guy in the yard driving the forklift today, but is there an opportunity for me to actually get involved in management, in making some more strategic decisions down the road? That's very enticing to folks, because they say, this is a career. This isn't just a job for me. So those are some things to think about operationally that you can do right now that will make your company a lot stronger in 10, 15 years when you say, yeah, I am getting to that 3 to 5 year period where I'm probably thinking succession.
Got it. All right. If my children and other family members don't want the business, how does that impact whether the estate tax will impact me?
Yeah. So good question. And there are two different ways to look at that, right? So number one is calculate that net worth, right? Get that appraisal and calculate that net worth so you know about where you sit today. So if children or other family members don't want it, that gifting is off the table. So it's going to be hard to move money from your estate into somebody else's in that route. However, there are other potential ways to look at. There's the option of granting. Are there key employees that maybe they're not owner, 100% or majority owner material, but maybe there's a way to incentivize them with a 5, 10, 15% grant of the business so that you're still in control, but you have brought somebody else on and transferred some of that value to them. So that can be a good way to do it from a key employee standpoint. The other thing is you can think about transition over time. And so this is where that post-ownership cash flow analysis becomes really, really critical. What are you going to need out of the business? Because if you're not going to need 100% of the business, and even if you are, it at least tells us where that estate value is compared to where we are today and where we might be in the future. And then how do we start moving things around? Is there a way to sell? Maybe we don't need the whole business, so maybe we can sell for 70 cents on the dollar. And maybe we need the whole value, but we have other assets that we can gift to different things. There was the idea of the charitable remainder trust. This can be a great option for folks that don't have family members who they can give business interest to, but maybe you sell 30% of the business and now you're sitting on some cash that you maybe or maybe not need, but you can gift that to this charitable remainder trust, move it outside of your estate, and you can get paid. The charitable remainder trust is similar to a foundation, right? It has to pay out about 5% a year. So you can create an income stream there while moving assets out of your actual estate, your taxable estate. So there's some different options here, and happy to get into more details and specifics if you'd like. Just reach out. Happy to go through that in your specific instance.
All right. We have two more questions. Does the annual gift exclusion reduce the benefit of an estate tax?
Yeah, so very good question. So in 2023, for individuals, 17,000, for married couples, 34,000. That's the annual gift tax exclusion. I can give that whenever. It doesn't impact what's going on overall in my estate. It's once I get over that 34, let's say for a married person, that's where it gets into, I'm going to have to file a gift tax return. Because what the IRS does is they keep track of how much you have gifted over your lifetime, right? So the limits we're talking today are lifetime exemptions as opposed to annual exemptions. And so a question, slightly differently that we get quite often is, well, can I just start giving some of the business away using the annual exclusion? You could, but it would take a long, long time. right? At $34,000 a year, if, most of the lumber businesses we value are somewhere between 3 and 10 or $12 million. Take a long time at $34,000 a year to give away a $3 million business. So just because you go over that amount, don't be concerned that you're going to be taxed. It just counts against that currently either 12.92 or 25.84 million exemption. But you will have to get with your accountant to file a gift tax return if you go over that annual exclusion. And the last point I guess I would make is we typically tell clients, use that annual exclusion for things like, hey, my kid just had now I have a grandkid. Maybe I'll put some of that into a 529 plan to save for their education in the future. That's a really good use of that annual exclusion. And then save that lifetime exemption for big things like the business, real estate, other types of really valuable assets.
Got it. Okay, and we're about out of time, but we have just one more. I want to just clarify for everybody. So you're an expert in succession planning, that kind of thing, estate planning. How about if somebody does not have a financial advisor? Is that a service that you offer as well? Or just tell us what can you do for lumber dealers?
Yes. Yeah. So that's an excellent question. So we have sort of 3 areas that we work with dealers across the country. And one is evaluation. Right? A lot of times we're called in because dad wants to gift a certain percent to the next generation. And so evaluation has to be performed and it has to be stapled to the back of a gift tax return. So we do a lot of those gift and estate tax valuations. We also do valuations in relation to bigger succession planning. Okay, Rick, your business is worth 5 million, real estate's worth 10 million. Let's start figuring out how much of that you need to fund your lifestyle. What other sources of cash flow do you have out there? How are we going to set this up? How do we implement it? Do you need to start hiring new people? So that's a huge part of that succession planning process. And it goes back to that great question earlier about, I'm not ready yet, but what can I be doing? The operations are a really key part. And so we come in and we help look at that. And do you have the right people in the right place? And can your business be sustainable? Because let's face it, every dealer we've ever worked with cares deeply about their employees, their customers, and their community. And so the idea is to make sure that this business stays independent so it can continue to provide for that community, because the people that work at the lumberyard, they use the local CPA, they shop at the local stores. It's money that just gets recirculated into the community. And we think that's really important. And so to the extent possible, if we can keep them from being sold to a big roll-up, and there are obviously times that makes sense, but we want to try to keep that money in the community. So that's a really key provision of what we're providing. And then there's a lot of coordination that goes on, and we can certainly help with the individual financial advising, planning, asset management, because you're going to walk out of this, if you do it right, with a chunk of money, whether it's paid up front or over the course of a number of years. How do you go from getting paid a salary to making $5 million last for 15 or 20 years? That's a different question. And so that's something we can either work with an advisor that you have, or we ourselves can handle that internally as part of your holistic succession plan.
Great. This is Sam. This is really, really helpful. So if anybody has any questions, Sam's info is on the screen. Reach out to him, email, phone. He's a wealth of knowledge. He's forgotten more about this stuff than most of us will ever know. And he's a good guy. So
appreciate it, Rick. Yeah.
Sam.
Thanks a lot. No, this is great. Thanks for everybody for attending. And yes, as Rick said, we're happy to take questions and happy to just walk through your situation. So thank you again for everybody listening in, and thanks to LBM Journal.
Thanks, Sam. Thanks everyone for joining us. We'll see you next time.